Hey there, welcome back to the channel. Today we will be diving into step-by-step from pre-approval to keys in hand. You know, buying a home can feel like a maze, but I'm here to guide you through what seem like arduous steps, from day one all the way until you can open that door. It's super exciting. By the end of this video, you'll have a 30-day roadmap to making your home buying journey super stress-free. So let's get started. So here's the game plan. We're going to walk through the entire process from pre-approval to closing with tips to avoid common pitfalls. Let's go. So day one, we're getting everything ready for getting pre-approved. This is your ticket to home buying. Pre-approval shows the sellers you're serious, and it shows exactly how much you can borrow, because without it, no one takes you serious. And sometimes realtors won't even take you out to see houses without a pre-qualification or pre-approval. So here's how it works. We submit your income, credit, and debt to a lender like myself. And we do a credit check, we do the math, make sure that the debt to income ratio is right, and then we figure out a loan amount. The easiest way to think about it from my perspective is generally we can use about 50% of what you make. So if you make $5,000 a month or $10,000 a month gross, we can use half of that for whatever debts you have on your credit report, and the leftover amount would be your maximum house payment. So if you make $10,000 a month and you have $2,000 in debts, well, 50% of $10,000 is $5,000. So we take the $5,000, subtract the $2,000 in monthly payments, and you are left over with a potential $3,000 house payment, if that's what you want. And then it's just a matter of figuring out what's available in your area and what you're comfortable with. So that's the basics. Like I said, we take a look at your credit, whether you're 580 or 780. I try to have a 24-hour turnaround. Some people do it a little bit longer, but I figure 24 hours is enough for me to kind of get the basics through, and as long as you're quick about getting your documents to me, then it all goes smoothly. You don't want to skip this step. Like I said, a lot of realtors won't take you out if you're not pre-qualified or pre-approved. So just bite the bullet, do the application, and today we're so digital that everything's super fast. A lot of people have everything on their phone anyway, so it's just a matter of sending a couple texts and getting it done. So once you're pre-approved and you know how much you're qualified for, now it's time to go house hunting. And this is the fun part. This is the HGTV part, right? This can go fast or this can go slow. A lot of it depends on the market. In Arizona right now, it's mildly competitive. So if you find the house you want, you go schedule to see it. There may be a couple of offers, but for the most part, as long as you're not in that really competitive 300,000 range or something, you're going to have a pretty good shot at least making an offer and being competitive. Ideally, you're only looking for homes in your budget. Sometimes there's ability to stretch depending on whether you negotiate closing costs and maybe an additional dollars for buying your rate down. If you do that, you could potentially afford more home. If the property taxes are cheaper, if for some reason homeowners insurance is a little cheaper in that area, there are little pieces to the puzzle that'll kind of move the needle a little bit. But generally, once you have an understanding of what your max pre-qualification amount is, going over that it can be pretty tricky without more of a down payment or some other funds coming from somewhere. So every real estate agent does it different. The normal old school way is for you to say, hey, I like these houses, let's go see them. And then you go and you run around town and you see them. I have a few real estate partners that will go online and really try to drill it down online. All our access to information and photos and all of that is crazy. A lot of houses will have video walkthroughs, so you can really get an understanding before you take the time to go out and see it. So ideally, once you're like, I'm ready to see these homes, you go out, you hit as many as you can or as many as you want to, and then now it's time to make an offer, and that's when the fun begins. And I've had clients find their dream home on day one, and their keys in by day 22. I've had other clients look for 30 days because something wasn't right, or the offers, they were getting multiple offers and they just weren't winning. So be patient. It's the red car syndrome. Once you want to buy a red car, you see red cars everywhere. Once you go to buy a house, then it really feels there's some sense of urgency. And unless there actually is a sense of urgency, take your time and find what you want, because you're going to be there for a little bit. And this is less of a thing these days with like I said, everything being digital, but keep your documents handy. We'll take copies of everything from the jump, and your access to documents is important. And sometimes, depending on how you get paid or the style of pay stub or whatever, like, we may need more information to clarify things for the underwriter. So just kind of something to keep in mind. So now we're at the offer stage. Super exciting. For purposes of timeline, let's say we're a couple weeks in. You went, took about 6 or 7 days to find the house, and now we're going to craft an offer. And that offer, ideally win-win. You pay what the guy asks. Maybe he'll pay some of your closing costs for you. The house is nice. Bada bing, bada boom. Depending on the market, you might be able to offer a little less. If it's a super competitive market where there's multiple offers, then you'll sometimes find people offering above asking, which is fine, not recommended by most industry professionals. But again, if you find the house you love and you have the funds to do whatever it is you want to do, then heck yeah. Alright, so you make the offer and you submit it to the seller, and they normally have 2 or 3 days to respond. If they accept the offer, then whatever you offered is now gospel, and that's what we're going to use to proceed toward closing. The other options that the seller has are to counter. Say you said, Mr. Seller, I want to give you full price for your house, but I'd like you to give me 3% toward my closing costs. Well, they're like, well, I really like that full price offer, but I only want to give you 1.5%. Well, now you have a choice. You can decide if that house is the one for you. Then you're going to say, sure, I'll take your 1.5%. I'll cover the rest of the closing costs. Let's go down the road. So once the offer is accepted, then we submit for initial underwrite. And all that means is an underwriter is going to make sure that everything that we originally discussed with income and credit and the property, nothing's weird. Every property has a different rule set. If you're on a condo, it's different. If you're a manufactured home, it's different. USDA loan, USDA versus conventional versus FHA versus VA. They all have different rules, and underwriters and loan officers, but specifically underwriters, have to know what the rules are. We go into initial underwrite. They're going to look at all of your income, credit, order the appraisal, and we'll get what's called a conditional approval. And then we'll have a new needs list, which could be new bank statements, or if you're using money from your 401k, we might need something from that. So anything that we're going to need to finalize the loan normally comes out in this conditional approval stage. So we send out a new needs list, we'll discuss it, make sure you have a good understanding of what's going on, and move on down the road. Now, keep in mind, this is something that a lot of loan officers, I think, pass over, and sometimes real estate agents don't talk about it either. When you're buying a home, there are a few out-of-pocket expenses that you might not know about. So you make the offer, you get the offer accepted. It's recommended, not required, but recommended to get an inspection. That means you're going to have a third-party person come out, take a look at all the big stuff. Roof, look for mold, check the pipes, look for leaks, check the foundation, windows, anything that might come up that would be a large expense, or would be something that you wouldn't want to buy the house anyway. If a house had mold and for some reason the family didn't say anything about it and they just painted over it, you're going to want to know that. So you pay the inspector. It's normally $300 to $500. Then the appraisal is required, and that normally is an out-of-pocket expense too. That's another $500 or $600. So your out-of-pocket expenses throughout the process are going to be somewhere between $1,000 and $1,500 probably. So, like I said, we go underwriting, conditional approval, appraisal is in the process of getting done. And we're crossing our fingers that the appraisal comes back, what they say, as is, meaning that there are no conditions to the appraisal. The way the house sits is satisfactory, and then a comparison model for finding the sales price matches our sales price or exceeds it. Because if it's below, then we have to go back and negotiate with the seller, or pay out of pocket to try to make the loan match the contract. That's another video, but sometimes it happens. So just be cognizant of that. If the appraisal comes in low, that's another conversation that we're going to have with the realtors and with the seller, and try to make everything right. Things to think about throughout the loan process, or if you know you're buying a house, don't go get new credit. I mean, it's not etched in stone that you can't, but if your numbers are super tight or your debt to income ratio is tight, and you go out and buy furniture or buy a car or what have you, like, that could be a deal breaker. So if you do feel the need or do actually need to do something with your credit throughout the process, talk to your loan officer. I mean, they'll probably say please don't, but if it's something that mathematically fits, then you got to do what you got to do, and those are things we can work around. Quick recap: we got our contract accepted, we have sent our inspector out, appraiser is scheduled, everything is moving right along. The underwriter has completed their initial underwrite. We have sent out new needs list, so ask for most recent pay stub, ask for, let's say you get a bonus. So for bonuses, that's a 2-year average that we do. If you just started getting a bonus this year, it's likely we couldn't count it towards your income, even though you can use it as money, we couldn't count it as income. So we're going to take a 2-year look back on bonuses, overtime, and tips, or anything variable. Obviously, if you're self-employed, that's always going to be a 2-year conversation. But yeah, if you get bonuses, you're a W-2 employee, we're going to do a 2-year look back. So we would collect your final pay stubs from the previous 2 years, just to see those bonuses and that they were paid out in that calendar year. So we got the underwriter, we've submitted all of our stuff back, the appraisal came in, and it is at value, which is what we want. So now we submit for final underwrite, and if everything is satisfactory, we will get cleared to close. And cleared to close just means that the loan side is good, and then we'll send out what we call closing disclosure. Closing disclosure is basically your loan before you sign on the dotted line. It's everything that all your closing costs, all the costs, title, underwriting, county fees, HOA fees, whatever it is. It's all in a very boilerplate document that is the same for everyone. So we walk through it, make sure you understand all the costs, and then we have to, once you acknowledge that you've received the closing disclosure, we have to wait 3 business days. And that's some newer rules, a lot of new little borrower-friendly rules came into effect after the 2008 crash, and that's one of them. So you have your 3-day wait period from when you sign your closing disclosure until you can sign on the dotted line with the notary. So whether you're having your own down payment or you're using down payment assistance, or you are paying your closing costs or the seller's paying closing costs, at this point you're going to know whatever funds you need to bring to the table, you're going to know based on that closing disclosure. And at that point you'll either wire the funds to title, or you'll go get a cashier's check, and when you go sign with the title company, then you'll bring it. They sign, they send the documents back to the lender, we send them a check. That's called funding. So then we fund and we record with the county. Sometimes that all happens in the same day, and if it does, then you're free to get your keys, get your gift basket or whatever we've put together for you, and it's time to move into your new house. So hopefully this was informative and answered a few questions for you. If you do want to get pre-approved or just kind of want to see where you're at, I'm going to put the application link down in the description here, and I'm happy to help you. I love this stuff. So until next time, my name is Todd Uzel. Hope you have a great day.